I think everyone talks about contribution margin, net margin, making profits. Without cash flow, hard to keep the machine running. You have the potential for healthy net profit, but like really weak and or even negative cash flow. It's the single most important metric. We're actually starting. Oh, sorry, my bad. I didn't realize we were actually recording.
That's actually a good cold open. Let's keep it. Well, Dylan, what are we talking about today? I'm excited about this one.
Yeah, we're talking about cash flow. I think everyone talks about contribution margin, net margin, making profits, but without cash flow, hard to keep the machine running. It's hard to keep growing. So I think it's an under talked about topic in D2C. I think there's some D2C brands where cash flow is a bigger kind of pain point and or thing to spend a lot more time thinking about. So I'm excited to dive in.
Yeah, for sure. And I think we'll get into some of those situations, like when is it, maybe harder for some brands than others. Obviously, unit economics play a large role, but also LTV, what the actual, let's say, acquisition strategy is, the growth rate you're trying to hit, all that good stuff. But maybe before we jump into all of that, why don't we introduce the concept of profitability and contribution margin? You already touched on those in the tee up to the video. So yeah, maybe you just want to set the stage kind of for everyone. When you think about profitability, contribution margin, I don't want to call them buzzwords, they're important, but why are they kind of taking all the focus away from maybe other KPIs?
Yeah, I mean, at the end of the day, most people want to increase profit. That's generally over time the goal of business in lots of cases, depending on your stage of growth. And for D2C, the way most people measure that is contribution margin after ad spend, or in my opinion, if a lot of people we work with do it that way, we suggest it gets done that way. A lot of our kind of partners suggest doing it that way. Essentially, what that means is you take your net sales, take out variable expenses, cost of goods, payment gateway fees, logistics, so the shipping costs incurred. And then you take ad spend, and then you're left with your contribution margin after ad spend, basically your profit pre-fixed costs. And the idea with doing it that way is that when it comes to setting marketing targets, your marketing team doesn't have all the visibility into the fixed costs. Sometimes or oftentimes fixed costs don't scale linearly. So like a lot of brands, let's say you have a target of say, you want to have 10% net margins, 20% contribution margin after ads, but you have 15% of your net sales go to fixed costs. You're only with 5%. So in that situation, you have two options. You either get more contribution margin, as in like you do more volume, so your fixed costs make up a smaller percentage of your overall net sales, or you have to reduce your fixed costs. So I think it serves as kind of the guiding metric for the marketing team in terms of some of the variables they can actually control. And I think for a lot of brands, especially in like the 7-figure range, sometimes it's actually relatively difficult to have a really like clean readout on what your COGS are. It depends how many SKUs you have, how many places you're ordering from. Are you vertically integrated? Are you not? Most brands of that size are not. So it's really an important kind of exercise and discipline to get those numbers right. So you're actually making the right strategy decisions that are rooted in actuals for data.
And what you're saying is really important because you're almost saying like win on absolute dollars, not just on the percentage points. Now, like you can still win in some ways on percentage points. There are ways that you can drive down certain costs, and whether it's logistics, cost of goods, other aspects of the business. But generally speaking, if you're sort of locked into certain unit economics, you really have to win on basically absolute dollars, which then ultimately means you're either reducing fixed overhead or you're increasing what contribution margin is, again, in absolute dollar terms. Because if you have a contribution margin, for example, of 150,000 per month, let's just throw that out as a number, you have fixed overhead of 200,000. You are not going to make that math work. So you have to get the absolute dollars of contribution margin up to cover what that fixed overhead is, or you got to get fixed overhead down to a realistic place where it actually makes sense to spend against and generate that contribution margin. Let's double click in the ad side. How do you think about, or how the brands at Aplo Group think about typically setting these KPIs, setting these targets, maybe from a spend perspective and kind of working backwards to either net income or net margin or contribution margin, maybe if we want to stick with that one?
Yes, I think that like a lot of brands kind of have like two kind of key targets. One is I want to make this much profit this calendar year, and the other is I want to grow this much this calendar year. And I think that there's still a good amount of people who think like growth first. So it's like, I want to grow this much this calendar year. However, I think our industry has matured. So there's now like actually more strict profit targets. So it's like, I want to grow this much, and I want to have at least profit dollars or X profit percent. We tend to recommend going after dollars more than percentages, but there's times where maybe the percent matters more. But overall, that's kind of like the starting point. And then when it comes from a planning standpoint, you kind of work backwards from there. Like what has to happen for that to come true? You can take the current trends and extrapolate that into a forecast of what you think is going to happen. How far or how accurate or how similar, is forecast to goal? Is forecast exceeding the goal? Is it missing the goal? And then if so, or if yes, how do you then go and kind of bridge that gap? So that's kind of the workflow most brands follow when it comes to like the planning of their ad spend. It's rooted in ultimately a forecast, but also a goal.
I love the episode you and John did about basically what's a projection, what's a forecast, and basically one is aspirational versus one is more of a pacing kind of estimate. So I like that one a lot and highly recommend anyone who hasn't checked that one out, check it out.
Mm-hmm.
But I guess, Dylan, let's jump into, so we spoke about obviously the importance of profitability and what role that plays in any business, but in our case, obviously in the e-commerce side. But why is profitability alone just a poor optimization? Optimizing for any single metric is generally a poor strategy, but why optimizing solely for profit leaves brands open to pretty major blind spots inside of their business and inside of their, let's say, financial decision making?
Yeah, so I think that what makes ecom uniquely difficult, and there's other industries that have the same kind of like makeup, but I've seen business owners who have done previous types of businesses previously jump into ecom and all of a sudden have a hard time kind of wrapping their head around the cash flow planning of it. And if you run like a human services business, like a law firm, an accounting firm, an agency, it's relatively simple. You have like most of your fixed costs are payroll, and then you have your revenue, and it's relatively simple to wrap your head around the cash flow of that business. It's not super complicated. If you have anything with a lot of capex or something where you're buying a lot of inventory before you sell it, like these things start to get into situations where you have the potential for healthy net profit, but like really weak and or even negative cash flow. So what does that mean? When it comes to ecom, how it actually kind of practically plays out is you need to basically often buy things before you sell them. And where the danger lies most frequently is in high SKU count stores. So if you have a ton of SKUs, and let's say I buy $100 worth of items, I've used this example a few times. I sell $50 worth of those items very profitably, but I like then run out. At that point in time, it's possible that the profit from that $50 is actually not greater than the value of that plus what I haven't sold for my most recent PO, so that I haven't actually recouped my entire investment from my first PO before I'm making my second PO. That's an example when you can have profit, but unfortunately you sold the wrong stuff, which isn't necessarily the end of the world. It happens, but you then have to go and buy even more goods. So with D2C, inventory planning is like incredibly crucial. Depending on how much equity you have on your balance sheet, that can also impact how much you can afford to get things wrong. But by and large, inventory planning as a discipline for high SKU count stores is one of the key things to make sure you're not only profitable, but you have the cash flow to be able to do other things with it, distribute it, invest in new stuff, et cetera, et cetera. If you're selling a CPG product, most commonly, or like a brand where you don't sell very many things, it's rare that issue happens as much because you're dealing with less variables on the planning side. So normally it's easier to really dial in your inventory plan if you're selling like 3, 4, 5 items or 3, 4, 5 variants. But if you think of like a clothing brand or like some of these D2C stores that have like thousands of SKUs, and each of those SKUs has like multiple variants or colors or sizes or whatever, these businesses have the potential to just be horrible cash machines if not ran with like the utmost discipline in terms of inventory planning. So yeah.
No, that's a good breakdown. That was well said. It's funny actually, because I think a lot of businesses start also, in my mind, the best way of thinking about the cash flow side is you're de-accruing a P&L. Obviously, it's not just that, but in a sense, that's what you're kind of doing. Everyone starts, say, when you're in the 0 to 5 range, a lot of brands start on the cash basis side. Now, some brands start on the accrual side, and that's great. It's so important for actually getting like accurate margins, accurate gross margins, understanding what your unit economics are. Like we can get into why accrual-based accounting is so important. But I feel like a lot of people start on the cash side, then they gradually move to the accrual side and start to clean up their books once the business is a little bit more mature. And then there's this exercise of this like, okay, great. Like I understand how to read and assemble an accrued P&L. But then it flips back to actually having to de-accrue that P&L and look at things both as cash flow and not just as profitability. And the reason is exactly like you're saying, because just because on an accrual basis, you may be profitable, you still have to come up, in the case of e-commerce, with all of that cash to float the expense of actually going and buying the PO, having the inventory on your books, having the working capital tied up in what's basically inventory on shelves until you go and sell it. And depending on how many days you carry, essentially what your coverage is, you might be locking up a lot of working capital in basically inventory in this case, and having to sit on it until you can actually sell through it and not only generate revenue and cash flow from that, but before that cost is even really expensed on your P&L. So it might actually look profitable when you basically forecast it out on an accrued based P&L. But from a cash flow perspective, you still have to come up with that money, and you still had to go to the bank and basically take a huge risk. And you and John use this term a lot. I love it. It's the risk adjusted bets that you're making in a business. Whenever you're placing a large PO, that's a risk adjusted bet you're making. You're taking essentially a lot of cash flow. You're taking that working capital. You're putting it into essentially a risk adjusted bet, which is I can sell this much inventory at this efficiency at these margins. And you're taking that working capital, you're putting it into that asset, and then you're selling that asset over some fixed period of time and expecting a return back on it. But I think that's such an important frame, because I think a lot of brands, it's easy to forecast out the P&L, but in terms of getting your working capital to line up with that, I think that becomes a much more challenging 3-statement type of exercise.
I think that like one big piece of this as well, and like I don't consider myself like the most experienced person when it comes to like negotiating supplier terms. Like it's not something that I do in my role at Aplo. But I think that just from a standpoint of thinking of your suppliers as partners, I think that when you actually have like proper financials in place, it allows you to go to these partners and actually kind of explain to them from your perspective why you might need certain things and why it could be hugely beneficial to them. I think that like some of the best brands we've worked with have like successfully, effectively turned their supplier into like effectively their lender. Now, not in like the traditional sense, but with terms. So like there's two things you can go and do. You can go and get terms, or you can go and get better pricing when you go to negotiate, or you can get worse. But hopefully you don't get something that's worse. Hopefully you're always improving.
Yeah, that would be ideal for sure.
I mean, that would be, don't go backwards. And what the benefit to the terms is that if you are a business that has healthy profit but has terrible cash flow, I'm going to go into it and I'm going to prioritize terms. And if you can explain to your partner, your manufacturer, hey, if we all of a sudden have these terms, I could do this much more volume with you. And yes, you may have to extend me some amount of time into the future for paying for a lot of this stuff, but the payoff for you could be X, Y, or Z. And I think if you actually understand your numbers, you can make a more like rational decision about how you're going to think about structuring some of these term deals. And additionally, I think you're going to be better at like selling your partner on why it's a good thing for them. So I think that like it's not just inventory planning. There's other things you can do around the payment of inventory that can get super crucial. But I really think inventory is like the single biggest kind of like key risk when it comes to cash flow planning. There's some exceptions, like if you have like a ton of debt, this, that, the other thing, it can really, really hamper your ability to have healthy cash flows. But for most brands we come across, the biggest risk is ineffective inventory planning and proper order sizing.
What are the common cash crunches that you see brands run into, Dylan? Like, what's the lead up? If you can kind of paint like a theoretical picture of like, here are the steps that lead up to a cash crunch. Here's what happens during cash crunch. And then generally like how brands can navigate it. I know that that's like, it's very business dependent. It depends on the scale of the problem. Sometimes, solvency is not something that you can unwind necessarily if the position is too dire and basically there's a lot of debt. What's kind of the precursor event or events that then lead to a cash crunch in your experience?
Yeah, I'd say there's like the two most common are like the high SKU count stores buying too much of the wrong things can be super profitable, but they just have cash tied up in unproductive inventory. So like the solution to that is, I think that like this most commonly happens in like the mid 7 figures. You don't have that many SKUs. You then realize if I want to get to 30, 40, 50 million bucks, I'm probably going to need a lot more SKUs. And then people start buying a ton of stuff, doing it incorrectly. And in fairness to them, they have limited historical data at that size. So it's really easy to get things wrong. I think it's a lot easier for like a mega corporation with a ton of historical data to make more informed decisions. So that kind of like mid 7 figures to like mid 8 figures range, we see like high SKU count stores get things wrong a lot. So having like an effective inventory planning solution team, etc., in that type of business is crucial. And then if you don't, you have to have a really good liquidation flow for the stuff that you kind of haven't effectively sold through, and thinking very seriously about how do I liquidate the inventory that I get wrong, because you're always going to get it wrong to some degree. Like it's impossible to always get every forecast and estimate right 100% of the time. So that's like the one. The other one is on the one of the other games is essentially like high LTV businesses. So the problem with them is if they want to scale, they often have to acquire customers at a slight loss. And at the end of the day, that is potentially fine based off of their CAC to LTV. However, you're often, how do you finance that loss on the front end? And if you do it right in some cases and you're not trying to be super aggressive, and this is still relatively aggressive, is like you're using the profits from the return customers to finance the acquisition of the new customers. And you kind of have plotted your pace of growth so that you're always staying net profitable and you're not scaling too fast. But some brands, especially if they believe that they're in a winner-take-all market and they want to go and basically just crush potential competition, you may then go and raise a ton of debt or equity and essentially just crank spend, and you're purposefully running at a net profit for some amount of time. And for those businesses, as you can obviously imagine, the cash flow crunch there is they can't do that without outside capital. And then the third most common would be like high one-time purchase stores. So stores where there's not a lot of LTV. And the risk there is if you have slim margins on acquisition, but you're still driving healthy dollars, there can be scenarios where you start moving through units at a loss. But that still may sometimes be a cash flow positive thing, depending on how healthy of a balance sheet you have to allow for that. Meaning, like, if you have a lot of equity in your sheet, you essentially can run through inventory in some cases for quite a while at a loss that can be net positive to cash flow, as long as you don't have to go and re-up to the same amount of inventory that you had previously. So there's those are kind of the three most common, but honestly, like by far the most common is high SKU count stores. Like, I want to raise an alarm bell. If you're a high SKU count store between mid 7 figures and mid 8 figures, if you haven't dialed in your inventory strategy in line with your cash flow planning, in line with your marketing plan, I'm just going to go wrong so many times. So I think people should do that.
Yeah, that's all super well said. And it's a fair warning because, that's actually probably the most common one that will run into this issue. I don't have much to add to that, but I will say one thing, and I'm curious your thoughts on it. I often think of this as like an expiration date for inventory. Some products actually have a physical expiration date. You can't sell it after a certain date, but you often don't think about that in something like a clothing and apparel item. You might actually want to, in your own mental framing, have some sort of expiration date that you put on these sort of products. And you can choose the expiration date that you want based on what your cash flow goals are, what your sales velocity is, what the how you would grade that unit of inventory, for example. But in a sense, you want to have a point after which you maybe are willing to move it at a slight loss or move it at a lower contribution margin, because freeing up that working capital is ultimately more important than trying to hold on to a unit that is not going to move. And it's going to take you many, many months or years in some cases to sell through because it was a either poorly timed bet or the cash that you tied up in that large PO that maybe was too large in hindsight is basically just sitting, and you're not going to see that cash come back to you unless you essentially decide to move it at, again, potentially a lower profitability, which again is that trade-off between profitability and cash flow. And you brought this up too, Dylan, in your last point there, where it's like you may actually be willing to sell something at a slight loss, but that's actually a cash flow positive exercise, because otherwise that was just going to sit there essentially unproductively on your balance sheet. And you can at least see that cash flow come back to you and redeploy it in a way that hopefully the next time around is more productive from a profitability and free cash flow standpoint.
At the end of the day, I just think that the D2C operator, it's actually a business that requires some pretty I would say it's a relatively hard cash flow planning game in a lot of cases. And I think that it's an underappreciated discipline if you're trying to maximize the growth of the business. And I think that more people should think about it sooner. It's really relatively easy to think of this stuff on a net profit level, a P&L level. The cash flow level, though, is actually what is the most time intensive and can be difficult because you have to deal with multiple scenarios. And there's so many things that impact the scenario coming to be, things compound on each other based off of it really is a lot of work. So I just think that if you want to basically maximize growth, maximize retained earnings, etc., it's the single most important metric. If I was running a D2C brand, I would basically prioritize net profit still matters. You can't just have cash flow and no net profit. But if I had to pick one that I looked at every day, I would pick that. I don't need to look at net profit every day. I should, but but I need to look at cash flow every day because I have to make sure I can pay the bills.
Completely agree. I also think it's funny because from my conversations with a lot of operators, and I'm curious if it's the same for you, I don't think anyone starts necessarily a Shopify store with the thought that, oh man, once we hit, an 8-figure scale, the number one thing that's going to be super hard to deal with is going to be, for example, this puzzle of like, how my working capital is tied up in all these different SKUs, or like, I don't think that complexity exists yet in the very early stages of business. Now, some operators that are coming maybe from like more of an ops background or a finance background, or they've worked in a previous e-com store, maybe they know that because they've had to see it happen. But I don't think that like, everyone likes to advertise the ARB or the opportunity in any market. I don't think people like to, advertise the challenges or the risks that come with it. And I think this is one that just like gets not spoken about enough, which is basically that it's actually a very, like to your point, like it's a very difficult cash flow exercise when you're operating the e-commerce brand at scale. And it actually is quite cash intensive because you are taking a lot of that working capital and you're putting it into what are effectively these risk adjusted bets. And you have to see those bets play out for it to actually accrue value to the business. But to do that, you really put a lot of chips on the table. And you have to wait months potentially to see that value come back to you. Now, depending on your unit economics, that value may be very well worth the trade, worth the risk. But at the end of the day, it is still a risk and there's still a lot of cash that needs to be put up front. And in the early stages, it's not as much, but at scale, especially once you get into sort of high 7 figures, low 8 figures, that's where things start to break. And again, depending on how your business is financed, you brought up equity in the, a few times that you touched on debt. Depending on what your financing looks like, what your available credit looks like, what your cash flow looks like, what your, willingness to potentially inject other cash into the business, or if you have investors, et cetera, like all of these things play a massive role because that cash is ultimately going to go on the balance sheet and turn right into inventory that you have to sit on and sell through, and ideally sell through quickly enough to recoup that cash and continue using it productively in the business.
Awesome. The words would be cash flow, cash flow, cash flow.
Well, Dylan, I think that's the pod. Anything else you want to leave listeners with from a cash flow perspective?
Just make sure you're working with a team or an internal employee or contractor, whatever, who's done it for e-com before, because people who haven't often have a hard time. Like the people who have the background in like the traditional kind of like wholesale world often jump into e-com and have a hard time wrapping their heads around it. Not that they can't, it's just like there's probably a learning curve. And it's just better to work with people who are e-com specific most of the time. There's always exceptions.
And probably the same goes for the other way. If you're going into wholesale, probably have someone who's done wholesale before as well, so that you understand that landscape. I think that's the pod, Dylan. Thanks for jumping on, and looking forward to the next one, man.